Ever wonder what happens to your money if your bank collapses? What do they do with all your hard-earned savings if they close the doors? Or if you try to log into your online savings account only to realize... Well, you might want to stick around as we walk through one of the most important things you need to know when opening a bank account, and that is... Hey everyone, this is AJ, your ace in the hole, and welcome to the channel where we simplify personal finance and provide tips for young adults, parents, and others just starting out. And sometimes we show you how to make sure your hard-earned money is protected. So let's go up, up, and away as we rescue the damsel in distresses savings account with an overview of the FDIC. The FDIC, or the Federal Deposit Insurance Corporation, was signed into law by President Franklin D. Roosevelt via the Banking Act of 1933. The FDIC protects depositors by insuring their money in the event of a bank failure. But there are guidelines, which I'll discuss. And hang tight, because I'm also going to show you not only how to maximize your protection, but I'll also provide a little hack that expands coverage into an area you might not have known was possible. The FDIC began insuring deposits in 1934 with a coverage limit of $2,500, increasing over the years to the current coverage limit of $250,000, with some stipulations which I'm about to cover. The most important note, since 1934, the FDIC has never failed to pay out during a banking failure. And these do occur with a reported 570 bank failures since 2001. Now, how do you ensure that you're insured? To start, let's walk through what is and is not covered by FDIC insurance. There are a couple of variables that constitute coverage, and I'm going to cover them all. But let's start with the very basics, which is your bank must be a participating FDIC insured bank. This is easy to identify either through signage at the banking location, online at the bank's website, or you can search for a bank's FDIC status at the official FDIC.gov website using the Bank Find Suite, which I'll link below. And if all else fails, a simple phone call to the bank can confirm. Most banks are FDIC insured, currently around 4,400 institutions. Just make sure you choose an FDIC banking location. One quick note, credit unions are not covered by the FDIC, yet are covered by the NCUA or the National Credit Union Administration, essentially providing very similar coverage. Now let's talk about what type of accounts are protected. Accounts that are covered are all the common deposit accounts, which include checking and savings accounts, money market accounts, and even CDs or certificates of deposit. Accounts that are not covered by the FDIC are investment brokerage accounts and investment products such as stocks, bonds, mutual funds, cryptocurrency, annuities, or life insurance policies. It also doesn't insure contents of safety deposit boxes, loss from fraud or theft, or accounts at non-FDIC banks. In short, the FDIC only protects traditional deposit accounts and not investment products or valuables stored at a bank. Now that we discussed what is covered, let's touch on who is covered. To be clear, the FDIC insures the banking depositor, the customer, you and I, and not the banks themselves. And, as mentioned, the current FDIC limit is $250,000, but this is per depositor, per bank, and per ownership category. Now, I'll elaborate more on ownership in a minute, but let's start with a simple example. Take Jake, a single successful businessman, holding all of his accounts at a single FDIC bank. He holds a checking account with a $50,000 balance, a savings account containing $150,000, and a CD account holding another $50,000. Collectively, he holds a total of $250,000, and should his bank fail, he will recoup all his money since he's within FDIC limits. Now let's assume he received a large company bonus, growing his savings account to $160,000, taking his collective total to $260,000. In this case, the $250,000 is still covered, but the $10,000 above the FDIC limit would be uninsured and possibly lost in the event of a bank failure. Now, one solution Jake might consider is to instead open his CD account with a different bank. In this case, he would have $250,000 of FDIC protection at Bank 1 and another $250,000 protection at Bank 2, now providing him more than enough protection for all of his funds. Now, there are other ways to expand FDIC coverage aside from simply moving money to different banks. And while splitting banks is one way to manage funds that may exceed FDIC limits, this can be more complex than necessary. I'll touch on additional options in a moment, but first, let's take a look at how ownership category comes into play. In this example, we'll use a married couple that has a joint shared savings account at a single FDIC bank that contains $350,000. I know they're doing really well. Now, what do you think their exposure is relative to uninsured funds? At first, you might think it's the $100,000 above the $250,000 limit. However, FDIC covers each depositor, so in this case, the joint account allows for $250,000 of coverage for each account owner. Therefore, this account would be covered in full, $250,000 per spouse or $500,000 in total. This is where the ownership category can help. Jake from earlier is considered a single ownership category, while the married couple with the shared account is considered a joint ownership category. Now, before I jump into more options and that little hack I mentioned earlier, let's take a quick look at the various ownership categories that can play a part in how you might position funds to help not only ensure your money's protected, but how you can increase FDIC coverage even further. There are quite a few ownership categories, as shown here on the FDIC.gov website, each of which can provide additional coverage depending on how they're used. However, today we're focusing on the most common, which are the single, joint, and beneficiary accounts, also referred to as POD or payable on death accounts. Now, let's move on to a few more examples that will help bring further clarity on how this can all be used to your advantage. First, let's bring back our married couple. As you recall, they had a joint savings account that would allow them up to $500,000 in FDIC coverage. In addition, each spouse could open separate single accounts, which would then provide an additional $250,000 of coverage each, bringing their collective total coverage to $1 million. Now let's take this even further, expanding on the POD or beneficiary ownership category. Using this same married couple, let's now add 2 children into the mix. By adding each child to the joint account as beneficiaries, this now moves the ownership category to a POD with beneficiary account, which allows $250,000 per beneficiary, moving this account from $500,000 to a grand total of $1 million in FDIC coverage. $250,000 for each beneficiary under spouse number 1, and $250,000 for each beneficiary under spouse number 2. Now, let's take everything we've learned so far and show a scenario to maximize FDIC protection to its potential. A single family of 4 might use this example, which is just one of many creative options. In this scenario, Dad owns a single checking account providing $250,000 of FDIC protection, while Mom also owns a single savings account providing another $250,000 of coverage. Together, Mom and Dad also own a joint savings account with both children as beneficiaries, providing an additional $250,000 per beneficiary for each owner, or $1 million in FDIC coverage. And finally, both children might each own a single savings account, adding another $250,000 of coverage for each, for a family grand total of $2 million of FDIC protection. If even more protection is needed, they could use this same approach at a second bank and double this level of protection. Here's what this looks like using the official Electronic Deposit Insurance Estimator, or EDI tool, found on the FDIC website, which is a fantastic tool to help model specific account scenarios. I also linked this in the description below. Now for that little hack I mentioned earlier. For the most part, investment accounts do not offer FDIC protection. However, should you decide to purchase FDIC-protected products within your investment account, such as a CD for example, this would provide a way to supply some level of FDIC protection for funds held within an account that would otherwise be uninsured. In fact, check out my beginner's guide to CDs here for some great tips on CD laddering, now that you know they are protected even within your investment accounts. So as you can see, with a little creative planning, there's no reason you can't accumulate enough FDIC coverage for all of your funds. Unless, of course, you win a multi-million-dollar lottery, and well, there are far more advanced methods for managing that situation. But us average Americans should have no issue protecting our hard-earned money with some good FDIC account management. All that said, I really hope you found this video helpful, and if so, please share it with others who might also find it useful. And be sure to like and subscribe so you don't miss out on future videos. And for more helpful tips, check out my video here to take full advantage of the federal gift tax code, or this video on maximizing 529 savings plans for education. Finally, thank you so much for watching today, and I really hope to see you back here for the next one. This is AJ, your ace in the hole. See ya!